Welcome back to Investing Alchemist, your go-to channel for demystifying the world of investing. I'm glad you are joining us for the 5th episode of our journey into the stock market. Today, we'll unravel why companies go public, how investors and traders participate, and the core reasons behind stock price fluctuations. Let's kick things off with why companies choose to go public. Companies enter the stock market for two primary reasons. First, it's an opportunity to raise capital for their expansion plans. Secondly, it provides an avenue to reward early investors and founders. Imagine Ramesh Tech Innovations. When it went public, Ramesh offered a portion of his company to the public through an IPO, initial public offering. In doing so, he put a part of his company up for sale in the form of shares. This means he sold shares to investors. The money from these shares goes into Ramesh's hands, rewarding him for his hard work over the years. Now, let's get into the basics of stock markets in India. In our country, there are two primary stock markets, BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. Most companies choose to list on both these markets. However, there was a time when some companies only listed on BSE. Now, let's talk about investors. Investors come in various forms, including retail investors like us, traders, foreign institutional investors, and domestic institutional investors. Their primary objective is to grow their money by investing in companies they believe will perform well. Here's how investors make money. They buy shares of a company with the hope that they'll become more valuable over time. When share prices go up, they can sell these shares and make a profit. They might also get a share of the company's profits as dividends. Conversely, we have traders. Traders aren't interested in the long-term growth of a company. They aim for quick, short-term gains. They buy and sell shares often, taking advantage of the day-to-day price fluctuations. Now, let's address a fundamental question. Why does the stock market exist? It serves a dual purpose. First, it provides a platform for companies to raise capital and grow. Second, it offers everyday people like us an opportunity to grow our money at a faster rate compared to traditional investments. The stock market works in two different parts, the primary market and the secondary market. In the primary market, companies launch IPOs to get money directly from investors. When Ramesh decides to make tech innovations public, he is entering the primary market. This is where tech innovations issues new shares to the public through an IPO. In our case, they offered 15% of their 1,000 shares for the public. When you, as an investor, buy these shares, the money goes directly to tech innovations. In the secondary market, investors trade shares among themselves, which affects share prices. Suppose you bought a tech innovations share during the IPO, and later on, you decided to sell it. You wouldn't go back to tech innovations to sell it. Instead, you'd find another investor in this bustling marketplace to buy your share. The price at which you sell or buy depends on the demand and supply, driven by investor sentiment and the performance of the company. You might wonder, How does the company benefit when its shares are already out there in the hands of the public? As the share price rises, tech innovations' overall valuation increases. Since Ramesh, as the founder, likely owns a substantial number of tech innovations shares, his personal wealth grows as the company's valuation increases. Share prices are determined by two main factors: the intrinsic value of a company, based on its financial performance, and market sentiments. Think of this as the true worth of a company. Companies are valued based on their earnings, assets, future prospects, and other financial factors. For example, if Tech Innovations is consistently making profits, has promising projects in the pipeline, and owns substantial assets, it's seen as a strong, valuable company. In this case, the share price reflects this strength. The share value increases because more investors want to own a piece of such a successful business. Market sentiment is like the mood of the stock market. It's driven by news, events, and public perception. Consider that Tech Innovations just announced a breakthrough innovation in the tech world, making headlines everywhere. This fantastic news creates a positive sentiment about the company's future, so more people want to invest in tech innovations. As a result, demand for tech innovations shares increases, pushing up share prices. On the flip side, if a negative story about the company breaks, perhaps involving legal troubles or economic challenges, sentiment turns negative, and share prices may decline. But why do share prices change every second? This happens because of the size of the Indian stock market. With trillions of rupees in stocks traded daily, new information, how people feel about the market, and people buying and selling stocks make prices change quickly. Let's say Tech Innovations announces a remarkable new invention during a live broadcast. Investors, watching the live stream, see the company's potential. Excitement surges, and they start buying shares. This rush of buying drives up share prices within seconds. However, it's not always rosy. If Tech Innovations were to reveal a significant setback in one of their projects, it could trigger panic among investors. Fear might cause a sudden flood of share selling, sending prices plunging. As we finish this informative episode, remember that investing is a journey of continuous learning. If you found this video helpful, please remember to like, share, and subscribe to Investing Alchemist. We'll be back with more interesting content soon. Until next time, happy investing.